welcome to Insights from the PM's Desk. I'm Justin Plouffe, Deputy Chief Investment Officer for Global Credit at Carlyle. We start 2025 with a highly complex investment environment. A new administration, geopolitical risks, and fully valued equity markets all have the potential to cause volatility in the year to come. Against this backdrop, we believe that loans provide strong relative value. This is largely due to the higher for longer view that the market has taken on interest rates. We also think that increased M&A activity is likely to occur in 2025. Let's start with loan returns. Not only have loans outperformed traditional credit asset classes over the last 5 years, but they've done so with lower volatility. This was especially true in 2022, when loans largely avoided the significant losses we saw in other markets. If you look at loan yields today, they remain elevated above those of high-yield bonds. Now, this has been true for the last couple of years, but it's not historically true. Why? Because leveraged loans are senior secured in the capital structure, meaning that in a default scenario, they should have lower losses than high-yield bonds. Or put another way, loans are paying you more for potentially a lower risk of loss. Loans also provide good relative value versus equity markets. Now, equity markets have rallied dramatically over the past 2 years, but today, by just about any measure, they are fully valued and probably have more downside than upside. Loans, on the other hand, are expected to have lower losses in 2025. Most market participants do believe default rates will be lower, largely because leveraged loan borrowers have performed very strongly and capital markets are wide open for refinancings. Now, one of the major trends in our market is the adoption of a higher for longer view on short-term interest rates. As you can see here, rates have come down, but the yield curve has flattened, meaning that the market expects rates to remain approximately the same for the foreseeable future. We think this is good news for M&A activity. Many companies and financial sponsors have sat on the sidelines waiting to see if rate cuts materialize. With a longer-term view of stable interest rates, we think more companies will come to market with M&A. And we're not the only ones. Most of the street is calling for higher M&A activity in 2025 due to stable interest rates, but also due to a regulatory environment that should be more conducive to deal making. So against this backdrop, where are we investing? Well, 3 key areas. Asset-backed finance, where continued pressure on bank balance sheets requires more private capital to step in to get these deals done. Direct lending, where we have a persistent premium for illiquidity and complexity. And then opportunistic credit, where transitional capital and bespoke capital solutions are needed by companies regardless of the market environment. We expect all 3 of these areas to be fertile ground for investment in 2025. Thanks so much for tuning in to Insights from the PM's Desk, and we'll see you next time.